Hello. Didn't expect to see you here. Hope you're doing well. So we're gonna be talking about Cloudflare today, which I find that it's a very nice name, really, Cloudflare. And this is a company that has been performing very well in terms of its stock price. That is, it used to be at around 17, about $17 or so, and it reached approximately 220 at some point over here, 222 almost, back in November 2021. So today, nowadays, is actually at 115 or so. And still, we want to examine and take a look at the financials of the company, see if it makes any sense for us to enter here. Obviously, we're going to be basing our decisions on what the company has been doing and whether it's actually beneficial for us in terms of, again, what the company has been making in terms of money. So does it actually make sense for us to enter the stock, or are we based too much off of growth? And even if we are based on growth, is that growth actually potentially going to lead to a lot of money for the company? We'll examine these things in this video. And I always try to be super objective. I'm always judging based on data. And I also take a look at growth, because growth matters a lot. But I want to see some financials that make sense. That's it. That's very important for me to invest in these kinds of companies, or any company really, or any investment really. So first off, let's take a look at the outstanding shares. And you can see here that the company has been diluting shareholders a little bit, which is not great to see. This is about 30 million extra shares about here. So that means that your current stocks are actually worth less because there is more supply in the stock market. And if the company keeps doing that, they keep diluting you, you could see drops in the stock price as well, continuing. And in some situations, this can be a good thing. If the company, for instance, wants to use that money for purchasing other companies, for example, for growing itself, that's a good thing. But if this is just to finance operations, that's suspicious, for you at least. You don't want to see that. Now, it's interesting to notice that the company has still been gaining about 53% last year, but actually lost 28% last month. So that's significant to see here. There has been a downtrend going on, as you can also see here. Another couple of interesting things that I'm noticing here. You will see that the projected growth of the company here is at 50%, 37%, and 33% for the upcoming years. So there seems to be some pretty nice growth, which is on par with other tech companies, but also shrinking a little bit compared to the previous years, also worth noting. And another thing is the PE is non-existent here, and if you're wondering why that's the case, this means that the company is not making money really. And a price to book ratio is also a very lucrative one here. So the price is 43 times $1 of book value. So $1 of share price actually gets you, so $43 of a share price, of a stock price, give you $1 of equity really in the company. That's what this means. So let's take a look at the financials and start off with the income statement. The first thing that I noticed in the income statement here is the really awesome revenue growth here from 60%, 43%, 49, 50, 51. That's great. You like to see companies that are growing their revenues, right? Of course, they're making more money. But let's take a little bit of a closer look here and examine the actual net income of the company. So the net income of the company after expenses is 10, minus 10, minus 87, minus 105, minus 119, minus 216. So the more revenue the company makes, the less they keep, the more they lose, is the story here. And the reason for that is, as you can obviously see here, the selling and general and admin expenses are increasing tremendously as well. And so the company's operations are putting them in the negative in terms of their income. And that's definitely not great to see. So let's take a little bit of a closer look at the balance sheet. Now, the balance sheet of the company can be a little bit misleading because it includes a lot of things potentially that not actual assets if you think about it deeply. So an acquisition could be, for example, it could be some money, some loans, for example. So this could be artificially increasing the balance sheet values, and if the money are not coming from operations, and they're coming, for instance, from sort of like procedures that look like loans, like for example, the company is issuing shares, is cash flow for the company is added to the balance sheet, but it's not coming from operations, and so you don't want to see this kind of lines in the balance sheet. You mostly want to see things that the company generates on its own, and not things that are financed from investors, because that's you. And the reason you're entering the stock and the company is to make money, not to give your money so that the balance sheet looks healthier. You shouldn't really care too much about that. Now, obviously, the role of the balance sheet is to actually balance these values. So you always see, a debt, for example, is a liability, but is an asset too. So this is why it's called a balance sheet. But there are tricks, accounting tricks, for example, from current assets and non-current assets, and current liabilities and non-current liabilities, that can skew this view for you actually, and so the balance sheet can be a little bit tricky. So, for instance, current assets are the ones that can be converted to cash in the next 12 months, but non-current assets are the ones that can be converted to cash later, like after 12 months. And so you can imagine that there can be write-offs and tricks that can lead to differences in these kinds of values over there. So we take a look at the total assets here, which seem to be growing from 163 million to 2.3 billion. And the total equity here seems to be less, from 121 million to 853 million over here. Still growing, and however, with some liabilities at hand as well. So as you can see here, the liability is growing too, quite significantly here. And long-term debt is one that massively grew over here and the previous year. It's also interesting to notice. Take a look at the cash flow. So the cash flow statement here, the cash from operations, which is super important, almost zero here, 3 million, minus 43, minus 38, minus 17, and then a 15 million gain for cash for operational profit. And cash from investing, the company seems to be spending some in investment in market and equity securities, which is a little bit weird to me. Like, I'm not sure why the company would spend money in other market equities rather than actually use it for capital expenditures or potentially buying equipment and things of that sort. That's a little bit weird. But okay, moving on. Cash from financing tells an interesting story here, because you can see that this is all positive values over here, which means that the company issued debt, more or less, or issued stock. Now, what happened here? Basically both. You can see that there was issuance of common stock in the millions over here in 2019 and a little bit later. And then you will also see that there is some debt happening over here for the company. And you will see it here. The company actually got some debt, a lot of debt. 500 million here and 1.2 billion here. So it's quite a lot of debt happening over here. And since we are looking at the debt, we will take a look at the solvency tab later, which describes this kind of debt as a comparison to the company's assets, basically. And we'll see how healthy that is. Let's take a look at the free cash flow, which is super important. Now everything is negative here. And again, with all the growth in terms of revenue, you would expect to see some positive values at some point. But you still see negative cash flow, and I'm not a big fan of that at all. So let's take a look at solvency now. Let's take a look at the debt. So the debt of the company, look at that here. 2017 was at 9% when you compare it to the equity of the company. So this means that basically they had let's say for $100 they had a debt of 9. That's what it means basically. For $100 that they had in equity, they owed $9. But now it's 146%. So for $100 that they own, they owe $146.3. So that's getting into very dangerous territory here. So the company, and you would expect that because we just saw in the cash flow statements that the company borrowed a lot of money, and you have to be wondering if they are not making any free cash flow, how are they going to finance this debt? Because they don't seem to be keeping any money. So what's going to be happening in the next few years? I can tell you what's going to be happening. They're going to be issuing more shares for more than likely, and keep diluting the current stockholders. And I think that the company's stock price has potential for actually coming down even more. That's what it feels like. I mean, you never know with the markets these days, but that's the healthy thing that you would expect to happen here. All right, so after we saw all this about the company, what do we do? So for me, when I see companies that have a decreasing cash flow, even though the revenues are increasing, and they have such debt, seem to be getting more and more debt every year, I can't see how I could recommend this for a buy, and I can't do that. Now, obviously, you can buy whatever you like, but I myself, I'm not buying this, and there would have to be some amazing changes in the upcoming years in order to even think about entering this company for me. So, what do you think? Would you buy? Are you buying? Are you in Cloudflare? What do you think about the company? Let me know. And if you did enjoy the video, take a look at this one that I made about lemonade and how to short squeeze it potentially. Yeah, that's a company. So thanks for watching, and I'll see you soon in the next video. Bye bye.